Hi, I'm Wylie in the Shepstone and Wylie Tax Department. On the 19th of December 2016, SARS issued an Interpretation Note 94, that sets out the income tax implications for the seller and purchaser when the purchase price of assets in the acquisition of a business as a going concern is settled or partly settled by the assumption of freestanding contingent liabilities. In terms of IN 94, the seller receives the benefit of being relieved of his obligation to settle the contingent liability if or when it materializes, and therefore must include the agreed value of the freestanding contingent liability assumed by the purchaser in gross income or proceeds as appropriate. The seller does not incur expenditure in relation to the assumption of the contingent liability by the purchaser and is therefore not entitled to a deduction. The expenditure relating to the contingent liability will only arise when the said liability materializes. The purchaser will incur expenditure only when the freestanding contingent liability materializes and the purchaser is required to settle the liability at that time. The assumption of the contingent liability by the purchaser relates to the assets acquired, and as such, the nature of the assets acquired will determine the availability of a deduction and/or allowance in the purchaser's hands. In light of the tax implications in IN 94, it is extremely important to clearly identify the assets to which the assumption of the contingent liability relates, and the value of that contingent liability when assuming contingent liabilities as part of a sale or purchase of a business as a going concern.